Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Wednesday, October 30th, 2019. Now that we have the Fed out of the way, and as well as Apple and Facebook, although Apple and Facebook, they just reported after the close today, so you're going to have to let the dust settle on that. In other words, you get the earnings report initially, followed by the conference calls, and then really once the market opens for trading tomorrow at 9:30, all your institutions will be out on the playing field, and they can't maneuver as well on after hours trades or the after hours session. There's not as much liquidity, although usually on a day like today you're going to see quite a bit more trading in Apple and all that. But either way, I always say give it a day, let the dust settle. But let's take a look at what happened today. Not a whole lot, I'll tell you. The Fed announcement at 2 p.m. and then the press conference afterwards was relatively muted. Sometimes you have some really big swings. Now, no surprise, because they gave the market exactly what it was looking for, another quarter-point rate cut. And although they kind of came out and indicated they're going to wait and see going forward, they didn't really, they most certainly didn't lock in another rate cut. But then again, it was not priced in already. The probability of a cut at I think it's the December meeting, was already relatively low. So, in other words, no change in the status quo there. And again, you're looking here at SPY on upper right-hand corner. We closed up 0.3% today, so almost a flat close, slightly higher. Same story. Nothing's changed in the technicals. Divergent high. And like I said, the markets continue to grind higher without any sell signals. We have divergences, and they've been building for a while, and they may continue to build as they often do. I'm going to take a look at one other thing we haven't looked at here recently. I'll move this here, divergent high, and that's it. So there's a minor trend line to watch on QQQ. Really, it's been more of a day trader's market than a swing trader or active trading. You recall last night I talked about this level here. We had a support zone on NQ, the Nasdaq 100 futures, which runs between 80.40 and 80.50. And so this morning's charts I'm watching, I posted we were still there. We traded there all night last night. We hugged that level. This is the chart taken in pre-market today, and still had us going up to hit at least that trend line. And then I've made a few updates since then. And so what I did from there, on the front page of the site, I posted, kind of walk through that trade. We had the downtrend line. I first pointed out earlier today we had amazingly six consecutive 60-minute candles. If you're trading off a 60-minute chart, you want to see, all that really matters is how that candle closes. 6 in a row hit that 140 level, either hit it exactly, went below it, and all 6 closed right on it or above it. None of those closed below that level there. So again, it was I can't move that down. Pretty much the level that held support today, again being that 18 or 840 level on NQ. And then I went on and said, I had taken earlier today, added to my NQ long there, with a plan to take book half profits when the downtrend line was hit, which it was, and then said I'll take my remaining shares out and close those out today, whether it was shortly, before or shortly after the close, when 81.13.66, just below that. So I had an order right there at 81.13. There is no 66 in NQ. It trades in quarter point increments. It's just how this charting program works when it doesn't snap to the nearest quarter point, unfortunately. So you call that 81.13.50 or so. And then here's the updated chart. You can see that was hit right there. And we've gone carried a little bit above it, but I'm out. Like I said, I'm flat. We are back testing this trend line right here on NQ, and where we go near term, again, it's more of an active traders market right now, and because, as I said, the risk reward is very poor. Limited upside, it appears to me, based on the charts, on the daily charts and 60-minute and weekly charts on the major indexes. Yet we don't have any sell signals, so it's not as if you can either be long or short. You have to be one or the other. For as far as swing trading, there's really no trade to be made right now, or no new positions to be entered. If you're already short, I'd say, my preference is to sit tight with swing shorts and then trade long around it, active trading like this. Or I should even, to clarify, trade long and short. So we'll see what the next trade is as I And the last update here on the front page was MQ target hit, closed out. We'll let the dust settle following the conference calls for Apple and Facebook, and then look for the next objective entry, long or short. That's where that 81.1360-ish level was hit right there at the high of that candle. So again, if you're wondering, well, what is there? If the equity markets aren't conducive to swing trading, what is? Well, first of all, the equity markets will be. Traders make money. Swing traders make money during periods of volatility, and that's exactly what we don't have right now. But let's take a look at the VIX. We haven't covered that in a while, and here's what I'm looking at. The VIX trades in ranges. Those ranges have varied over time. In other words, when you go back, you look at a weekly chart here. You can see that at one point right here, and this goes back a decade. Forget about, let me turn off all the trend lines and just show you something here. All right, so way back when, coming into about 2013 or so, this was the low end of the VIX. That was a range you wanted to look to get ready to get short, look for turns in the market, corrections and levels there. Yeah, that's when you wanted to be buying volatility and or getting ready to short. Now you don't short just because you hit the bottom of the range. I'm going to get to that in a second, but that's where you do short from the bottom of the range, but not necessarily right when you hit it. Why? Because you can trade on there for a while. But I wanted to show you that this was then the bottom of the range from about 2013 to 2016. This was a record low, never before seen in the history of the VIX. We've never reached such an extended low period of volatility, and from such levels of low complacency and volatility came one of the biggest drops that we had up to that point in years. That was the correction that came in early January 2018 in the markets, and VIX exploded to the upside. Now, so this is the more recent range here, back to where we were really back at 20. If you exclude that abnormally low, again, never before seen, and probably never will be seen again, at least not anytime soon, I believe. We're back to the normal range back here from 2014 all the way through. I should have extended that line. I don't know why I had it stop where I did. That low end of the range right here went all the way into the beginning of 2017. You can see the earmarks down here. So that was our range back then, and that has been our range again, while excluding that period of extreme low volatility. So here we go. We look back at the daily chart. I've had this support zone here forever and a day, and it's pretty simple. As I said, you don't necessarily go short just because you get to that level. Here, let me do something for you here. Let me turn off all. No, I'll leave the annotations on, and I'll just overlay the. We'll look at the Qs because that's volatile. Where's QQQ? We'll just enter it here. QQQ. All right, so here's QQQ, and what I'm going to do for you real quick is circle the corrections or the tops in QQQ right here. That was a near top. We had a little spike near double top and then a big drop. By the way, if you can't see it here, this line goes all the way down. That correction didn't end until here. That was the big drop from last fall into the December 24th lows. This was our biggest correction since 2019, I'm sorry. All right, there's your other top, second biggest correction, and here we are now. So what do those all have in common? Well, excuse me, they all started from, you got it, that support zone. But here's why you don't necessarily short right when you get to that support zone, because what can happen sometimes is one and done. You hit the support zone there and boom, the correction's happened. Here you hit it, and I'll tell you, it came shortly there afterwards. Look where we are now. We're very close. We're not there yet, but we're very close. And again, sometimes you hit it, and it's not to say that you did have a correction right there after you hit it. You hit it again here. What happened? You went to the bottom of the zone. You can see little corrections each time you hit it. But finally, after this period of persistently low volatility, that's when it played out for, and it makes sense too. The more complacent the market gets, lower the volatility, meaning the stock market's holding up, usually the bigger the drop because it becomes a one-sided trade. Shorts have given up, longs become complacent, thinking the market's going to go up forever. Same old, wash, rinse, repeat scenario. So I wanted to point that out. Here we are, and let's get rid of the comparison there, and just focus on the fact that the VIX is now approaching that level. So what do you do when I just said you don't necessarily short the market or buy the VIX long just when it hits that level? What you then do is you align it with the technicals. And right now, the closest thing I would say is that trend line on the QQQ right there. It's gotten a little bit sloppy on this 60-minute chart. We still have the negative divergence. Right now I'm not seeing any cleanup trend lines. I could maybe draw one here. See, I hate to force things. Like I said, trading's been kind of sloppy, so I'll just have to keep updating you guys if I see anything, clean sell signal. It may come in the form of some type of candlestick, bearish candlestick reversal pattern. We had a potential setup for an island cluster top, and we still we have this cluster of candles right here, so that's one thing to watch. I mean, right now the futures are up with Apple and Facebook reporting. We have these 3 candles here separated by a gap, and maybe a gap down tomorrow, but as of now it's not looking like it. But again, I've seen Apple, Facebook, I've seen a lot of companies blow it out of the water with earnings, only to see that stock have a sharp rally afterwards and then a big reversal after the conference call, or sometimes just on the following day once the institutions, you got a lot of retail traders bidding stocks up in the after hour session, and then the big multi-billion-dollar pension funds, hedge funds, if they decide, okay, Apple had a great quarter, but that's it, the sun, what is the expression that it's always darkest before it's dawn, meaning during this point here, it looks like there's no bottom in sight, and the inverse holds true. Everything's rosy, and that's a lot of times when institutions want to sell. They want to distribute on good news. And I'm not saying that's going to happen tomorrow. We did have a bearish engulfing candle on Apple yesterday with a confirming red candle today. So let me just say this without mixing words. Should Apple reverse, let's see where they are tonight. Let me look at that real quick. Here, we'll move it up here. You guys can see Apple trading right now on pre-market. I'll move up to right here in the top. So here it was. There's where we closed. They popped it all the way up to 252.50, and they faded it back down. Now it's still, and again, a lot can and will happen between now. It's 4:44 p.m. Eastern time, so we have a few hours left in the after-hour session, and then we have the pre-market session tomorrow, and then again, most importantly, what happens to Apple after the opening bell. So a lot can and will happen between tomorrow. Let's not try to read too much into it, but again, going back to that daily chart, and I'm focusing on Apple because it is, of course, one of the the top components of the NASDAQ 100, top components of the S&P 500. So we'll watch that. See if there's another red candle, because that is a bearish engulfing candlestick, is a pretty high probability, pretty reliable topping stick if and only if you have followed through confirmation via an additional red candle. All the better. So if tomorrow Apple closes, I'll keep it very simple. If we're either down pretty big during the day or we close red, that's a pretty decent sell signal on Apple, and that's going to also be a sell signal on the market because of the importance, the weighting that Apple has on the index. There's a minor trend line that was broken here on the daily chart, and then you can see here I have a price channel between these two lines. I know this chart looks like a Christmas tree. Forget about everything else you see there. Just focus right here on this. Again, this trend line and this trend line, which form a price channel. Minor trend line broken right there, and watch, keep an eye on that. And we'll wrap it up here. So until then, members of the site, you guys know my theme lately has been trade things that don't trade in line with the major indexes. Don't trade heavily indexed stocks, because the market has gone nowhere now. Of course, you hear about it all day long in the press. New highs, new highs. But again, this was the previous all-time high right here. We're only slightly, barely above that. That was the previous high before then. That was the previous all-time high before then. And that one and that one. And so we go back all the way to this all-time high right here. At the time it was an all-time high in January of 2018, going almost close to 2 years now. And I measure from there to where we close today, we're up 6%. I know CD rates are low right now, but that's about what you would have got if you locked in back then on a 2-year CD. 3% a year. That's what you're talking about on the stock market. So from a risk reward profile, and you had to ride that out. And again, we had, of course, a big down, a big up. But so far this year, this is our trend. It is upward. Again, I'm going to give it that. But it's a market that's losing momentum, and that is evidenced when you look at the momentum indicators on the longer term charts. You look at the weekly. That's what this is all about. That's these divergences. They are the RSI, the PPO. These are momentum indicators. And when you have prices moving higher, as they have been, but at a much slower rate than they were before, much slower rate of ascent, and you have your momentum indicators moving down, that's negative divergence. And it tells you a market, yes, the trend is up, but the uptrend is losing steam, it's losing momentum, and that's where you get the corrections. This back here was a biggest correction, and up until that point, we had a nearly two-year sideways market. And don't forget that the big drop, which was the biggest correction since this bull market started back in 2009, that 22+% drop right there was clearly foreshadowed by the negative divergences. In fact, the day we broke support, I triggered and posted on the front page, major sell signal triggered on the US markets, and saw this one coming. This was priced into the charts. Turn on CNBC occasionally, and I hear everyone talks about how nobody saw it coming. And one thing I hear now, which I don't hear anybody talking about this back then, is the high yield market credit spreads. They say everything's hunky-dory now because credit spreads aren't flashing a warning. Credit spreads are the difference that junk bonds or high yield bonds are paying versus treasury bonds, and so that's relatively low. Well, I've used that in the past also as a red flag and heads up for corrections, but I can tell you that we had absolutely zero tick up in credit spreads before that happened. So all I'm trying to say is that some of the reliable indicators that have worked in the past don't always work. This is a different market. There are a lot of moving parts of this market, and so that doesn't mean we must go down. It just means that you may not get that tick up in credit spreads that you did last time, but I've already covered that in other videos. I can also tell you this: the junk bonds are way down off their highs. This is JNK, and also at resistance as well. So that is not a bullish sign. If this were to break out JNK, that would be somewhat bullish for the market. It would show you high yielders rallying. It would mean that the smartest of smart money really comes through this. There is a lot of buying pressure from the retail public. No offense to anybody. I guess I'm in that category. As a retail trader, even though I do it professionally full time, but for my own account. So what we're called the dumb money. Smart money, they pour through this, but they're not always so smart. But what I'm trying to get at is they're reading through the financial reports of these companies, these that are high yield, issuing high yield bonds or have high yield bonds out there, and right now they're not flashing any big red flags. If you start to see this diverging, that's where you really want to watch. There is some divergence here. Here, I'll show you. Let's go back and we'll just put on the tech heavy QQQ. There is some divergence recently. You can see at this point right here, junk bonds have now gone lower from where they were with the Qs, and I'm picking on QQQ because that's what's driving this market, the tech heavy Qs. And well, the S&P 500 also just hit a new high. So it doesn't matter which one I put up here really. But that's something to watch there as well, is look for continued divergence here between high yield and the equity markets, and that's usually a red flag. You can see it right here. And these are small. Again, these were small divergences. Junk going down, stock market going up, stock market corrected. Right now, junk bonds made a lower low. I mean a lower high, stock market made a higher high. We'll get a correction soon. And again, back here you can see there was really, you didn't have much of a warning sign there. It was pretty much flat with the market going flat, and then the market just dropped. All right, that's it. I'll keep it, it's not short, but that's really all I want to share right now. Well, let's see how things shape out here. And again, we don't have we don't have the very clear clean up trend lines that I like to see on QQQ and the tech sector, although they're still back testing on the weekly charts. So we'll watch Apple. Let's see how that goes. I want to watch the semis in the coming days here, and if I see anything that stands out, I'll let you know. Until then, we continue to focus on the things that don't have a high correlation, like our BYND long trade today, and natural gas, which we've been trading long and short, and crude, and treasury bonds, which were up today again. By the way, that's another thing, guys, I didn't mention it here in this video, but to members, I've covered those charts. Bullish developments recently in the 30 and 10-year treasury bonds. They were up pretty sharply today, and they held those gains. So that doesn't mesh with the stock market going up. That's a flight to safety bid there. So keep an eye on that as well. Any continued upside, and again, I've laid out some levels that will increase the chances for more upside in treasury bonds, and that's another thing you want to keep an eye on, because that could be smart money moving out of equities into treasuries. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope